Hello, everybody, and welcome to the monthly market memo for the month of September 2025. I'm Case Eichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we wanted to walk through some of the market returns for the month of September, what was driving those returns regarding key themes for the month of September, and some of the key questions that we were fielding from investors like yourself coming across our desk for the month. So without further delay, let's go ahead and get into it. It was another good month for the stock and bond markets. The stock melt up continues, right? We were well off the April lows a few months back, and we've really got seen gains here in May, June, July, August, now September, for several months in a row of positive returns. This month, it was led by S&P 500 type companies, U.S. large cap companies, if you will, narrowly beating international stocks. But overall, up about over 3.5% for the S&P 500. Small caps were up over 3. International stocks were up over 3. Everything beat cash. It was just a really good month of September returns for stock and bond markets. That leads us into not only the end of the month, but also the end of the quarter, right? The end of September marks the end of the third quarter. And again, if you've been watching these videos the last few months, I've just been talking about a lot of good news regarding stock markets. And we've seen small cap stocks really led the way for the quarter here, for third quarter up over 12%. International stocks over 7, close to 7. S&P 500 close to 8. Everything beat cash again at 1% on the quarter. Now let's just also look at year to date as we're kind of getting towards the end of the year already. It's been amazing how fast this 2025 has been going. But if we look at 2025 year to date, I'm going to hit a third asset class, which is international stocks. S&P 500 was up the most in September. Small caps were up the most in the third quarter. International stocks were up the most for the year. So up over 26% over the year to date 2025. And those are definitely adding the most value in your portfolio right now at up double digits at 26%. Everything's beating cash. U.S. bonds are up over 6. Cash is up just over 3. So still a really good year. It continues in September. And let's talk a little bit about an anomaly, I believe, of why that's been happening. Typically, September is a tough month. If we just look at crunch the research here for the historical returns for month by month, year over year, and September has been the worst month, if you will, to find those returns in the stock market. As I'm showing in this chart here, you see the dotted outline there of September down a little less than 1%. It's really the only month, maybe outside of February and August, that see negative returns on average. And the just the percent positive is less than 50% as well. So we really bucked that trend. We broke that trend with September being higher. And we lead into the fourth quarter here with some very good seasonal patterns setting up for us after we got past a typical rough month of September. Now, kind of leading into that, I wanted to talk a little bit about investor optimism. You and I and all the other professional investors out there, we take surveys, we get recorded, we're in the financial press. And 2025 has been a somewhat really good year for the stock market, but a surprisingly bad year for investor optimism. Bearish sentiment, if you will, people expecting the market to go down, have outnumbered bullish sentiment, people expecting the market to go up. But this is actually a good thing. And as we often quote, the market can climb this wall of worry that I'm going to show here, because we've seen 28 new all-time highs already in 2025. A couple more here in the fourth quarter as I record this. But overall, we've just seen bearish sentiment much below the average. Bearish sentiment much above the average. Typically, we see investor optimism being positive. You see a lot more bulls than bears, but 2025 has really been somewhat of an anomaly where bears have outnumbered the bulls. And this is important because this does shape short-term trends. But as I've wanted to get across here, this is more of a contrarian thinking, is when there are a lot of bears out there. That's actually a good thing. That's something I pay attention to that can keep this bull market running. Now, let's talk a little bit about this bull market. One of the questions we get is, are we near the end of it? Valuations are high. Is this something we should be maybe taking risk off the sidelines? Of course, always discuss that with your financial advisor for more of your in-depth situation. But overall, this is still a very young bull market. About 3 years in length is where we're at. maybe the bottom or the third or fourth inning if you're a baseball fan here. It's September. It is playoff time. But if we look at other bull markets here, as I'm charting out, see that dark red line? I'm going to point to it here. This is really the where we're at right now in the bull market. And we believe that this is still a very young bull market, and that history shows us that. And we can definitely still see more positive returns on the horizon, which leads us into optimistic thinking for the rest of this year and for the rest of next year as we lead into 2026. So, still very young bull market. We believe this bull market has more room to run as I talk about it. Now, some of the other key themes in September, the big one was the Federal Reserve, right? The Federal Reserve cut the overnight rates or the very short-term rates by 25 basis points. That happened in mid-September. I talked a lot about this leading up to this in my August review of why this was going to happen. So please take a look at that if you haven't. And this does resume that cutting cycle that we really started about 1 year ago. If you can see, September of 2024, we started to cut rates by 50 basis points, 25, 25, 25, and then we leveled off. We've resumed that cutting cycle, and now we're just over 4% on the effective Fed funds rate. This will affect your CDs at your local bank. This will affect other short-term lending as well. But overall, that's a good thing. That is going to be, we believe, a tailwind for risk assets going forward, and it can't allow that bull market to continue. This cut was unanimous. There were a few people that were wanting, maybe, sorry, I think it was one person looking for a 50 basis point cut. But all in all, a 25 basis point cut was done. And really, we talked about this last month, but why was this done? Was we've seen the jobs numbers really start to slow to a grind here. As you can see, kind of on that far right side of this chart, if you can kind of squint a little bit, but you just see the number of jobs being created has been very low. The moving average of 3 months at a time has been very low as well. So it's definitely cooling. And we've seen the unemployment rate, which is something the Fed really looks at, shift higher. This is since 2023, around April is when this unemployment rate started to tick up. And we've seen this tick up about 1/3 of 1% per year almost. And we started at 3.4, now we're at 4.3, and it's just been grinding higher. And the Federal Reserve has noticed this and taking note that where interest rates are at now are somewhat of a restrictive stance and they need to cut. So this was what Jerome Powell, the Federal Reserve Chair, called a risk management cut. They are choosing to focus on the labor market that's cooling over maybe a somewhat sticky inflation right now, which may prove transitory if these tariffs maybe come on and off, but more of a transitory inflation number. Now, there's been some curious things that I found interesting about this is we are cutting rates. We probably will cut rates next month and probably again in December, depending on data if we get it. But if you look at the numbers and if you look at the Federal Reserve, they really pull themselves on where they expect GDP growth to be, where they expect inflation to be, and where they expect unemployment to be. And I just wanted to hit this really quick, but they do believe GDP growth to go up compared to last time they were polled in June of 2025. So September, they believe it's actually higher than what they expected last time. They believe it to be higher in 2026, and they believe it to be higher in 2027. So this cut could actually stimulate growth higher, which may prove to be more of an inflationary part of the economy if necessary. Now, I draw that line there to move higher. And then they do expect the unemployment rate to actually come down in 2026 and in 2027. So the unemployment rate's coming down, growth is picking up, and then I'm going to circle this on inflation, that inflation they expect to actually come in a little bit higher in 2026. So what this all tells me is, yes, there's a rate cut. There probably will be another rate cut here too by the end of the year. But after that, I think we'll have to wait and see where the economy is. If inflation stays sticky, if the unemployment rate kind of settles in, and if the jobs GDP growth can increase, there really is no need to cut substantially into monetary policy. So 2 to 3 cuts is expected, as I mentioned, to really get us more to a neutral rate, if you will, by the end of Q1, less restrictive. But I think the question that I get a lot leading into the end of this video is, Where does this lead us for the rest of this year regarding short-term rates? Well, I talked about it, right? We're going to see more cuts. You should expect short-term rates to come down, and I expect about two Federal Reserve rate cuts for the rest of this year, and really kind of pause after that. Maybe one in Q1 of 2026, but I think it's too far out to really tell. So we'll get potentially two more by the end of this year. But where does this lead for mortgage rates, right? Where does this lead for maybe longer term treasuries? And that's the question that we've been getting is with the Fed cutting rates again, will longer term rates move down, being maybe the 10-year and your 30-year fixed mortgage if you're looking to buy a house? And really, that's what we wanted to point out is that longer term rates follow a path set by market participants like you and I buying and selling bonds, not the Federal Reserve, right? So we just kind of really saw this last year. The Federal Reserve was cutting rates, but you actually saw the blue line, which is the 10-year yield, move higher, right? So even though the short-term rate was coming down, the 10-year rate was moving higher. Again, the anticipation of higher growth, which the Fed expects, the anticipation of maybe higher inflation, which the Fed expects. So we kind of saw something similar so far this year. You saw the 10-year rate really move down much lower up to Federal Reserve rate cut day, and it got down to close to four, maybe a little bit higher than four on that day. And then since then, it's moved higher. It's wiggled around a little bit as I record this, but it peaked out at around 4.2, came in anticipation of this around four. So you really have to look at the market dynamics to tell, but overall, bonds are still a good place to be, we believe, for those risk-averse investors. And cash, even though it's being cut, can still provide a ballast for your current spending habits. It's still above inflation, so cash is still a good investment as well. But all in all, this rate cutting can lead to better returns in equities, we believe, and the bull market can continue. So, with that, that's where I'll leave you. Thanks again for listening. Thank you for your trust, and thank you for watching. We approach the management of your financial landscape very seriously as a trusted steward, advocate, and confidant. We're completely committed to you, the client. Again, please reach out to us with any questions. These videos are meant to be very informative, but if you have questions, you can always reach out to your financial advisor at RetirePath. Myself as a chief investment officer, find more of my writing and videos on our website at retirepathadvisors.com. So with that, we'll leave you there. We'll talk to you next month, and I hope everybody has a happy and safe September. Thanks, everybody. Bye.